All right. Good afternoon, everyone. Again, this is Jerron Levi, Senior Director of Government Affairs at the National Community Reinvestment Coalition, NCRC. We set up this webinar largely because of the the COVID-19 stimulus package passed by the Congress at the end of December. And we thought it would be a good time to catch up on some of the relief efforts that are underway at SBA and other agencies, including the U.S. Treasury, but also to just follow up on a webinar we had last year on the latest around mortgage loan forbearance and rental forbearance and moratoriums and loss mitigation at FHA, Fannie Mae, and Freddie Mac. So we thought it was a really good time to sort of catch up. There are a lot of fast moving details of all of these programs. And I think it's important that people are checked in and paying attention and engaging their constituencies around the country because there are a lot of small businesses, a lot of homeowners, and a lot of renters, CDFIs and nonprofits really in need of the assistance that is available. And there are a number of tight deadlines. So so we're going to start with the U.S. Small Business Administration. We have William Briggs, who is the acting associate administrator of the Office of Capital Access at the U.S. SBA. We've asked them to come on and talk about the Paycheck Protection Program and the new changes that have been included as a result of the economic stimulus package passed last month, but also just generally all of the SBA assistance that has been, that is available through that agency. We also have Diana Seaborn from the Small Business Administration and Rosemary Drake, also from that agency. I think they have a slide deck available. So I'm going to turn it over to Bill Briggs and so that we can get started.
Thanks, Ron. I'm just, yep, can you hear me?
Yes, I can, loud and clear.
Great. I'm just going to speak very briefly, and then we'll jump into the substance of the presentation. I am the acting associate administrator, so my term ends tomorrow. I've been working very hard with the new administration to make sure that there's a smooth transition and that they're up to speed on all facets of the economic aid program. I do want to thank in particular NCRC for their leadership throughout, particularly the Paycheck Protection Program and their work with CDFIs. Our focus of this round of PPP has been making sure that we are doing everything we can to reach minority, underserved, female, and veteran-owned small businesses. And we know that your membership is a key part of that effort. And so we want to make sure that we're providing all the resources we can. Again, we want to thank NCRC for their leadership and their continued engagement. We know they will be there going forward. And most importantly, Diana and Rosemary will be continuing. And they're the people who you really want to get to know. Diana is effectively the head of our Office of Capital Access Policy, and Rosemary is head of the 7A program office, which oversees PPP2. So you have two of the top policy experts who will be there to answer any of your questions today and going forward. And again, Jerron, I just want to thank for your leadership on a personal note and everything you have done over the last 10 months to help SBA better reach all communities.
Thanks, Bill, and thank you, Jerron, and everyone for asking us to participate today. We're going to try and move through rather quickly because, as you know, there's a whole lot on your agenda today. The slide deck is available for you. Many of you may have seen parts of it before. We try to update as time goes on those things that are important to you. And first of all, we appreciate your participation. Secondly, we appreciate your immense patience as we pull together these very large historic programs and assistance, and there's varied, as Jaron had indicated to us in some of the questions you have, there's various different programs besides PPP that are in play here at SBA. So I am the director of the Office for Financial Assistance, and our team is the policy shop for SBA's business loan programs, which includes Rosemary, who is the chief of our largest program, and that is the 7A program, through which the PPP loans have been presented and made available to small businesses. We have a 504 team that is the certified development companies that do large fixed asset loans. And we also have a micro lending team in our policy group that issues the very small loans and has a very focused product, not just for lending, but also for technical assistance for very, very small businesses. So let us launch into this little presentation. It's brief. As you know, Bill has spent a lot of time encouraging and reaching out before we opened the gates for all other entities to make sure that community financial institutions came into this second draw opportunity with these new funds before all of the very large and very active lenders came in. And so we worked beforehand. Our systems team did a lot of hand-holding, did some education, but we wanted to make sure that these portals were open for first draw and second draw, obviously to the CFIs first. We've had a very successful week in getting everybody up and open and up to speed. And as you know, today, all of our lenders are now using the program. The lender match, however, will continue to direct borrower inquiries to our mission-based lenders, which are identified as the CFIs. And this has been a really, really good tool for us and for businesses, not just through PPP, but also lenders that participate in our regular programs get matched through here too. That we've had great success with this. We encourage you to use it and to make it known to the communities that it's available to them. And we will only make references to people who are approved to do SBA lending. So it's no predatory lenders, no people that we don't know to be a part of the SBA community involved in lender match. And I think that's very reassuring to your customers and to you. Additionally, as we go through the process, and I'm not sure that we've identified yet, we will be setting aside certain dedicated hours to process and assist the smaller lenders with their PPP loans. So don't be intimidated, just keep moving them through there like everybody else, and continue to communicate with us if there are systems issues. Next slide, Rosemary. Okay, first draw and loans and forgiveness updates. The eligible applicants for a first draw loan, someone who has never received a PPP loan prior to August 8th, now has the ability to apply for a first loan up to and through March 31st. The eligible PPP loans have been revised to include a couple of additional types of entities, news organizations, destination marketing organizations. So some things that work very closely with your economic development teams and universities are now eligible where they might not be forced. You might want to go back and take a look at some of those to make sure that if you have any customers that are in that category, they get an opportunity to come in for their first loan. We've expanded, the use of non-payroll cost proceeds to cover just about any operational expenditure, anything that it costs your customers to get their businesses into the best place possible given the pandemic, whether that's outside seating and heaters, expanded access to e-commerce deliveries and things of that nature. So remember that the split for both first draw PPP loans and second draw PPP loans is 60% payroll and 40% those other covered costs. Some of those folks that did not get adequate funding due to miscalculation or changes in rules from the first go-round can in fact be eligible for an increase to the original loan amount. That's a very limited set of circumstances. We do have written guidance out on that, and we'll go through that at the end. Next slide. This is something that just is a primer on who is eligible: business entities, independent contractors, self-employed individuals, certain 501c organizations, housing cooperatives, et cetera. Next. Forgiveness update. So the borrower has the option now. The 2.5 times monthly average payroll is the same. It doesn't change the maximum loan amount you're eligible for, but you can now take between 8 and 24 weeks anytime during that period to spend those proceeds and to be eligible for forgiveness. So if 12 weeks into this exercise, you have made your payroll, you've paid a lot of expenses, put some PEI in place, paid your rent and things, and you've used the proceeds, you can apply for forgiveness. You do not have to wait till the 24-week period ends. You do not have to do it immediately after 8 weeks. So it gives you some flexibility to spend the money, because we know some businesses now particularly are in restricted operations yet again. One of the good news pieces here is that we do not deduct the EIDL advance, which is that grant amount portion of an EIDL loan. It's really not the EIDL loan, but we have an opportunity through the disaster program to get up to $10,000 in an EIDL grant. Basically, it's called an advance. And before, we were reducing the PPP forgiveness amount by that portion, whether it's $1,000 or $2,000, it was up to $10,000. We no longer do that. The current legislation said, please don't take any EIDL advances out of that. So all loans coming in who had a PPP loan and an EIDL advance are no longer having the EIDL advance deducted from their forgiveness. Those that happened before this rule changed, we will be issuing reconciliation payments to the lender to be applied to your customer's outstanding balance. So we will be making those adjustments. It's probably number 3 or 4 on our list. So first, we're trying to get our PPP launch, but stay patient. We're getting ready to put out guidance on that. And so that will be out soon. We're also working on the guidance, which should be out within the week, on a simplified forgiveness process. And as you know, those of you who have been in the program for the first round know that it was $50,000 and less. They got a very simplified application for forgiveness. Now it's loans of $150,000 and less, which really is about 75 to 80% of all the loans that we did in the first round. And I would expect that it would be at least that in the second round as well. Next slide. Second draw loan, basic requirement. You have to have received the approval of a first draw loan. So for those of you that received your loans under the first round that closed on August 8th, certainly you have had, obviously, your approval for your customers have been approved. Most of them have used the proceeds in accordance with the requirements, and so they would be eligible to request a second draw loan with certain contingencies. For those of your clients that don't have a PPP loan now, they are in fact entitled to come in and request a first draw loan, have that loan approved, and then if they're able to certify subsequent to that they're going to use all of those proceeds in accordance with the plan, they can in fact apply for their second draw loan as well. You cannot disperse the proceeds of a second draw loan until all of the proceeds of your first draw loan have been used. So you can get the loan approved, a second draw loan can be approved, but you cannot use those proceeds. It cannot be dispersed to your customer until that time as the first loan has been fully used. Doesn't mean forgiveness has to happen, just that you have fully used the loan proceeds. So for a new loan, between 8 and 24 weeks from the time that loan is approved, they're going to use that money. And at that time, that's when the second draw loan can be dispersed. It can be approved, but not dispersed. The maximum loan amount for most everyone is the same, and that's 2.5 times average monthly payroll cost. The absolute cap on these loans is $2 million. Second draw loans, maximum loan, $2 million. For accommodation and food service, which is fondly known to all as NAICS Code 72, the maximum loan amount can be calculated at 3 times the average monthly payroll cost. And you have the option to use 2019 or 2020 payroll costs to calculate the loan amount. There are 2 very extensive notices that came out over the weekend and this morning that tell you exactly how to calculate the amount of loans for the first draw loans and the amount of your loan, as well as the reduced 25% reduction in gross receipts, how to calculate that for the second draw loan. So we have a link to that at the end of the presentation, and you'll be able to have that. Go ahead, Mary. Who can apply? We've already kind of gone through this. You have to have received one. You can get it approved. You have to use it fully before, and you cannot have more than 300 people employed with you for a second draw loan. The first one was 500, this one is 300. So that's the two distinct differences: $2 million cap, 300 employees, a 25% reduction in gross receipts. And the FAQ on how to calculate that is very specific about what's included in gross receipts. Okay. Starting with our resources here, anything that you have with regard to using the system, the platform by which you submit loans or submit forgiveness, this is the forgiveness.sba.gov. That is the platform now that handles all intake for PPP and all processes as well for forgiveness. One site, one platform, web options as far as information, www.sba.gov/PPP will bring you to our page. And I'll tell you that our page isn't as intuitive as we'd like it to be, especially for people who don't live in it every day, and we do. But we're working on it. Everything is posted there. The Treasury's website also has a posting of all of the documents relative, and will continue to do so as we move through the change in administration, of course. We have a new Treasury team coming on. We have some partners there that we have worked with all along that will continue to work just as we will on the programs, but they continue to be the authorized agency for the program, and we are still the vehicle through which these things happen. The questions on the platform, there's a very, very nice screenshotted user guide for anyone who's got new people coming on to get into the system or getting familiar with it. It has some really good screenshots of what's where and how you respond. And next, Rosemarie, I think this is the final. The web interface. This is the final web interface. It's the Office of Disaster Assistance. They have a general customer service line that's here, 833-572-0502. That's for getting an EIDL loan now. And if you're requesting an EIDL advance at this time, all of these things need to go in through the Office of Disaster Assistance. That's a direct loan program, a direct funding program, where we have lenders like you that work with us for the PPP programs and the guarantee loan programs. The disaster loans are directly made by SBA. Okay, that's the end of the presentation. Rosemarie, I don't know if you can flip to the just the list of links. We have live links for you all in one place that you can go, and if it's not easy for her to put that up here and post right now, we can do that while we start to take questions, Jaron, if there's questions that we can start to answer. We'll have Rosemarie put that up in the meantime, and otherwise it's available to you through the group here.
Okay, well, we do have some questions. I'm going to go to the questions that the participants are asking first here. And so Awesta Sarkash asks, when should borrowers apply for forgiveness if they take a second draw? Now, after the first draw, prior to applying the second time, or after they take out a second PPP draw?
That's a good question. So if you're a borrower who is or will receive a first draw loan, certainly you should spend that money first. Once you have used the proceeds and you're in the covered period or at the end of your covered period, you may request forgiveness at that time. I encourage you to do it as soon as you have used the proceeds, only because the process can take a bit. And so we want you to be able to see if there are any issues and be able to resolve them in a timely fashion with regard to forgiveness. However, the requirement is that you must do it no later than 10 months after your covered period. So for anyone who received their loan before August 8th, that covered period ended December 31st. So you have until 10 months, after December 31st, which is October 1st, to submit a request for forgiveness. At that time, if you haven't submitted the request, you will begin making loan payments on your loan as prescribed by as prescribed by the lender. So do you need to do that before you receive your second loan? You can get the loan approved. The second draw loan may be approved before you have finished spending those other funds if you're just now getting your first draw loan. So you don't have to have forgiveness completed before you apply, but in order for you to disperse those funds in the second draw loan, the borrower has to use all of the proceeds from the first draw loan, and you can confirm that, at which time you can disperse the already approved second draw loan. And then that loan again has a longer period before you have to request forgiveness. But you have to give yourself at least 8 to 24 weeks, somewhere in between that, because we're giving you 10 weeks basically of payroll costs. And so 8 weeks is the earliest time at which we believe you would be able to expend those funds in accordance with program requirements. So I would expect the forgiveness request to happen somewhere between 8 and 24 weeks in general, but you have that period through October in order to request the forgiveness for either loan.
Okay, thank you. We have another question. SBA, they want to thank you for the variety of translation of the top line overviews for the first and second draw PPP loans. A colleague who works with Arab-speaking small business owners said the Arab document was translated well and she will share it. 2 questions. Any plans to interpret into Arabic speaking languages via video with an Arabic speaking language interpreter? Any other translated documents other than via Google Translate?
Good question. We don't have any planned video presentations at this time, and I'm not sure how far along they are in having any other kind of interpretation prepared, multilingual interpretation or conversion through what we have on the web page. But what we can do is take that question back and confirm what multilingual guidance SBA and Treasury intend to put out going forward.
Okay. All right, thank you. Can a business start up after February 2020 apply for funds due to government restrictions on the amount of traffic flow? If you don't understand that, I can ask the asker to clarify.
Right. I don't know probably the second half of that, but the bottom line is if the business didn't exist before the pandemic happened, they're not eligible to take a first draw loan. The business has to have existed, even if it was just for a short period of time, 1 month of LAP of 2019 or January or February of 2020. What we do have, though, is our regular loan programs, which provide that long-term capital. So 7A, 504, micro lending, those are all opportunities for new businesses to come in and seek financing to get started, provide working capital, and provide financing for other assets as well.
What if a company didn't need help the first time around, but is struggling now to get equipment repairs paid for so that they can keep paying crews and keep operating? Is there some help for them?
So the options for someone in that scenario, I believe, would be for payroll. To make payroll, you would be eligible to apply for a first round PPP loan at this time. That's assuming that you were in business during the prescribed period, which was before February 15th. And alternatively, if you need equipment and you need other support, we have the long-term idle loans. So our disaster loans are available through this fiscal year, I believe, and they are very long-term and very low interest rate loans that do things like help businesses get through the challenges that they've had during this pandemic. So the options are a first draw PPP loan, which must be used for payroll at the rate of 60% of the loan proceeds, with 40% being used for utilities, rent, and other expenses that may free up capital so that they have the funds to repair equipment.
Okay. I'm sorry, going back to the question about translations, it was actually a question about whether there were any plans to interpret into American Sign Language via video with an ASL interpreter. there was an acronym here and I wasn't, or other
Okay.
translated documents other than via, so you answered the second part, but American Sign Language was the question, really.
Right. So we need to check with our comms team and the web services people in order to give you that correct answer. But we'll check into that and provide it back through the folks here, through Jaron and her team, so that you have answers, more definitive answers on that.
What if a company didn't need help the first time around? Okay, you answered that question. Sorry. Are there resources that SBA can provide to advocates to encourage, support lenders to reach out to Black and Brown business owners? For advocates, community-based organizations to reach out to MBEs to share information on the PPP. For example, a list of MBEs in our community.
So we have 68 district offices who are very connected to their communities. They have a list of every lender that's active in every SBA program in their region and in their market. So we have 68 offices statewide, so that if you go to our website, it will direct you to the closest district office, and they have a team of people who are local that work with every lender, with every institution. So they would be able to identify for you who are the lenders that are participating in their area. They would be able to connect you with other resources to assist with getting into lender match, if that's something that they're interested in, whether it's a borrower looking for lending or a lender that wants to be out there saying, hey, we have this money and this is what we do. You can opt in and you can be very specific about the size or the type of the kind of deals that you're able to finance. Rosemary used to be one of the head folks in our regions down in the Southeast. And Rosemary, do you have anything else you might add as far as resources?
Sure, yeah, definitely with our local district offices as well, as Diana mentioned, but in our resource partners through our small business development centers and other centers that work hand in hand with our district offices would be the best source to get that information. And they do send out regular communication to all markets, especially the underserved markets and the local markets.
Okay.
The more partners they have at that level, the happier they are. So please reach out to our district offices.
Okay. What does a sole proprietor need to do? Two questions here. What does a sole proprietor need to do to apply for the PPP first draw? They are a trucking company. And if a company received the first PPP and they did not hire all positions back and they did not have a reduction in income, can they apply for the second PPP?
Rosemary, you want to take that?
Sure, I can take it in part. So for sole proprietor, as with any other type of business entity, there's how to calculate your maximum loan amount. On the website, it gives you the breakdown of what you would need to provide to calculate your maximum loan amount, whether you use a 1099 or whatever schedule you use, it'll give you those calculations. For the second PPP draw, you have to have a reduction of 25% or more in your 2020 or 2019 revenues in order to qualify for that second draw PPP. So if in fact you're going to use the first draw, you've not received a PPP loan for the first time in the original draw, you just have to meet the qualifications from the first PPP loan, which doesn't require a reduction in the the revenues. It does require you to provide information with regard to the size standards, and then you would submit that to a participating lender in order to qualify for that. Again, 60% of the PPP loan has to go towards payroll costs, and the other 40% can go towards the other cover expenditures with regard to the operating expenses as listed prior into the presentation, and that would provide for you to be eligible for in whole or part forgiveness.
Right. So to Rosemary's point, if you received the proceeds of the first loan and you weren't able to keep as many people on staff as possible, maybe People resigned because of COVID. Maybe people were terminated. Maybe you offered to rehire them and they did not choose to return to work. There are some safe harbor options that allow you to say, look, I did try to do that, but it wasn't viable for me, and these are the reasons why, and you can document that. So it's possible that you could have that situation, but now are in a situation where you're hiring the people all back and could use the second draw loan. But that second draw loan, you have to meet the 25% reduction in gross receipts. How do I find a lender if I've never had a loan? Two ways is to contact the district office, and they will tell you all of the lenders that are participating. And number two, on our website is Lender Match. And if you put the information in there about your company and give them contact information, all of the lenders that participate in PPP and our other loan programs look at this. And so they can look at it and say, this is somebody in my community, or this is something I could do, and they will contact you. They will opt in to contact you. So two options. One is to go to Lender Match. One is to go to the district office and have the team help where you are locally identify those resources for making the loans for PPP.
And Diana, I would like to add to that, as we reach out to the business owners, we want to make sure that everyone understands it's a delegated loan program. So the lenders are making the determination for eligibility up front. So you would not come directly to SBA.
So we're coming to the end here. So these are probably yes, no answers really quickly. Will chambers of commerce be eligible?
I think across the board, I couldn't say yes or no, but what I can tell you, if there's destination marketing components of that chamber or connected to that chamber, that they should look into the new rules, because there are certain aspects that may be eligible.
Okay. Concerning the idle adjustment offered, do I have to request this adjustment, or will my lender automatically include this request?
Right. Your lender doesn't need to do anything, and you don't need to do anything. SBA has a record of everyone who received an idle advance and everyone who had it deducted. So we will take care of that and provide it to the lender with the instructions to apply it against your loan balance.
Are we required to go through the same lender for the second PPP draw?
That's a really good question, because you are not required to do so, but let me explain, one of the little finessing things you might want to keep in mind, and that is that lender knows what they put into ETRAN. ETRAN only knows, which is our processing system, what was put in there. So if the EIN number is, ABCD, and for some reason the EIN number would be different or the company name would be different, then it's going to cause a problem in the system with it trying to find you, because you're not allowed to have a second loan unless you've received a first loan. So it's going to go back when your lender puts it in, it's going to say, okay, did they get a first loan? And if it's not exactly the same as it is in ETRAN, it could be a problem. So one of the things I say is, if at all possible, it makes sense, but it's certainly not a requirement. If the lender is not participating in this round, you're welcome to go to another lender. Make sure that you disclose everything you can to them as accurately as possible so that they can assist you as quickly as possible.
All right. Is there anything you can say briefly? I know this is unfair. About the employee credit. I assume they're talking about the employee retention credit and how it is reconciled or aligns with
right.
loan forgiveness.
Yeah, I'm sorry. I wish I had really comprehensive answers about this, but the problem is we have many different sources of benefits here. And so, one of the issues for businesses is, if I take this benefit, does it box me out of this benefit? And that's a really good question. So anything that involves anyone other than SBA, I try to defer answering directly, because I don't make up those rules, So if you want to know whether PPP loans are taxed, I can tell you that answer. But if you want to know how IRS specifically treats, those recipients of PPP loans or some kind of HUD loan or other federal financing, then you really need to look at Treasury's website or HUD's website or the website for whoever provided the program. And I'm sorry, I can't answer it any better than that.
Okay. One last one, and then we'll let you go. I thought um, if you were not qualified for the first loan, you could not apply for the second one.
That's true. That is true. If you weren't eligible, because, well, yeah, if you weren't eligible, you can't. You have to have received a first loan. And so if you haven't received a first loan and you now believe yourself to be eligible based on modifications to rules, then certainly I would investigate applying. But what you might be eligible for is the first loan. So if you didn't need it then, as some of our audience has indicated, if you didn't need it then, but you found that this is a protracted pandemic, it wasn't over in 90 days, and you need it now because of restrictions on business and lower income, or just the need to keep payroll paid while your sales are off or stabilizing, then you may be eligible for the first. I'd recommend going back and talking to a lender about your eligibility, as long as you were in business by February 15th, and you're a business type that was approved before. So you really should at least chat with a lender about your eligibility for a first draw loan.
Okay. Well, I want to thank you all for joining us this afternoon. We may follow up. Please, I got a lot of requests for your presentation and the contact list, so please share that with me immediately after, and we will get it around to the participants on this webinar. I really appreciate you taking the time and answering all of these questions, and thank you for the work that you're doing.
No, thank you too. You're a wonderful partner. We need partnerships in all that we do here. Above everything, please stay well. Take care of your family. And once we put on our own air mask, we help everyone else. So that's what we're going to continue to do. Thank you so much for including us, Rosemary. Any parting words?
No, thank you. And definitely reach out to our local district offices. They're always readily available to help you. Again, we have 68 district offices. Thank you and be safe.
And if folks, thank you. And for the participants, if your question did not get answered, I will still try to follow up and see if I can get an answer for you. So don't despair. And you will also get the presentation and the contact list. Okay, so thank you. Before we move on to the Federal Housing Administration, originally we had planned to have speakers on from the U.S. Treasury, because there may be some significant changes in how they execute their programs after the transition to the Biden administration. They wanted to wait, so we may do a follow-up call a little later with those folks. But I did want to cover two key programs that came out of the economic stimulus package in December, and that the first being the and in the reminder about this call, we did include some links. So I'm just going to go over just a couple of things that I know that are on the website, but from also talking to staff at Treasury. Again, these are fast moving programs with some deadlines. So at Treasury, they are implementing the emergency rental assistance payments, the emergency rental assistance program, which makes available $25 billion in assistance to households that are unable to pay rent and utilities due to COVID-19. Those payments will be made directly to the states and the U.S. territories and local governments with more than 200,000 residents, and to tribes. So as I understand it from the agency, all 50 states have applied, as well as several localities and tribes. They really had to have completed payment information and signed acceptance of award terms had to be submitted by January 12th to ensure payments are made within the 30-day period specified in the law, in the economic stimulus package. And apparently if the eligible states and localities didn't complete that information by January 20th, they may not receive emergency rental assistance payment. But as I understand, most, all of the 50 states have applied. There is a question about some of the localities. Not less than 90% of the funds awarded to the states must be used for direct financial assistance, including rent, rental arrears, utilities, and home energy costs, and other expenses related to housing. Remaining funds are available for housing stability services, including case management and other services intended to keep households stable, and administrative costs. Funds generally expire on December 31st of this year. If you go to the website, you will see a list of eligible local governments, so that you will know, maybe who to check with locally in terms of how they are implementing their emergency rental assistance programs. There also is a very helpful, frequently asked questions document up now on their website, just posted. And I really encourage people to go to it because it answers a lot of definitional questions and questions about utilities and whether you have to have rental arrears, what kind of outreach your state and local governments have to make to landlords, and other really helpful information. So I really encourage folks to rely on that. They also have information about eligible households. Generally, to be an eligible household, it's defined as a renter household in which at least one of more individuals meet three factors: qualifies for unemployment and has experienced a reduction in household income, incurred significant costs, or experienced a financial hardship due to COVID-19, demonstrates a risk of experiencing homelessness or housing instability, and has a household income at or below 80% of area median income. The rental assistance provided can't be duplicative of any other federally funded rental assistance provided to that household. Eligible households that include an individual who has been unemployed for the 90 days prior to the application for assistance, and households with income at or below 50% of the area median are prioritized for assistance. And household income is determined as either the household's total income for the calendar year 2020 or the household's monthly income at the time of application. So anyway, I think if you go to the website, you'll see some very helpful information on the emergency rental assistance. The application for rental assistance may be submitted either by the eligible household or by a landlord on behalf of that eligible household. And you do have to apply through the established states and localities. So again, households are eligible to receive up to 12 months of assistance as well, plus an additional 3 months if the state or locality determines that extra months are needed to ensure housing stability. So those are just some top lines on the emergency rental assistance, but I really would stay tuned to what your state and localities are putting out, but also the guidance on the federal website if there's helpful information in both places. I also wanted to mention the Emergency Capital Investment Program included in the economic stimulus package. This is an entirely new program. Under the program, Treasury will provide $9 billion in capital directly to depository institutions that are certified CDFIs or minority depository institutions to, among other things, provide loans, grants, and forbearance for small businesses, minority-owned businesses, and consumers, especially in low-income and underserved communities that may disproportionately be impacted by the economic effects of COVID-19. Importantly, there's a second piece of this program that will also come, and it'll provide $3 billion in emergency support through the CDFI fund. So this is going to provide $3 billion to the CDFI fund to provide grants and other financial and technical assistance to CDFIs, including CDFI loan funds, as they serve consumers, small businesses, nonprofits, and their communities responding to the coronavirus pandemic. Importantly, I put up a link. There is a link to the Emergency Capital Investment Program in your information sent with this webinar, and they have a draft application that they have now posted to the website so that you can start to collect the type of information you will need. The draft application applies specifically to depository institutions that are CDFIs, but they will have to put forth a lending plan, and there are some pieces in there to consult with their local communities, and so and to do some outreach. So anyway, just be aware of that, and also aware of the upcoming grant program through the CDFI fund. So email me at glevi@ncrc.org if you have questions there. I will try to work with the agencies to get those questions answered. And so I'll leave it at that. Next, so I do see some questions about which websites. First of all, you should have got links to several helpful websites in advance of this webinar, but if you did not, we will send it out again. That's the first thing, so check your email. But also you can simply Google Treasury and Emergency Rental Assistance Program and Treasury and the Emergency Capital Investment Program. So if you Google those two programs, they pop up pretty quickly, but we'll resend those links as well. So thank you very much for that piece. And, but again, you know, I'll put my email in the chat. So if you have follow-up questions, please feel free to reach out. So with that, I'm going to we have a wonderful speaker from the Federal Housing Administration, and to provide some updates on some of what they are doing through HUD's National Servicing Center around loss mitigation and just steps they are taking. So Matt Martin, the director of HUD's National Servicing Center, is on the line, and we so appreciate it. And I will give the floor to you.
All right, thank you, John. Appreciate it. Good afternoon, everyone. I'm going to share my screen here. Let me see if I can figure out to do this. Okay, so these are slides that I kind of went over last time also that you might recognize, but they are still relevant. We got our loss mitigation program out fairly quickly whenever we did the whenever everything came about under the pandemic. So we have had a couple of extensions of time. Mortgagee letter 2020-43 extended the foreclosure and eviction moratorium through 2/28, and mortgagee letter 2020-44 extended the time to apply for a forbearance through 2/28 also, and depending with the new administration, those potentially could be extended further. But the key changes to our loss mitigation options for borrowers that were affected by COVID-19 include the home retention options for the owner-occupant loan mod, the combination partial claim and loan modification, a FHA HAMP loan modification and partial claim with reduced docs, and a non-occupant loan modification. We also added in there the COVID-19 pre-foreclosure sale and COVID-19 deed in lieu of foreclosure on the disposition options. So if a borrower is experiencing hardships that negatively impact their ability to make on-time payments due to COVID-19 and makes a request for the forbearance, then the lender must offer the borrower a COVID-19 forbearance. The COVID-19 forbearance allows for one or more periods of reduced or suspended payments without specific terms of repayment. All borrowers are eligible for the COVID-19 forbearance regardless of the delinquency status of their mortgage. And mortgages may approve the initial COVID forbearance no later than February 28th, 2021. Just extended that from December 31st. The home retention options. Owner-occupant borrowers who are current or less than 30 days past due as of March 1st must be reviewed for the following COVID-19 home retention options after coming off of forbearance. So the first option would be the standalone partial claim. The partial claim is a junior lien on the property. The note and mortgage are paid to the secretary. It's simply an advance to help the borrower overcome their arrearages. The lender gets reimbursed for their advance through a claim, and the borrower, the partial claim goes on to the loan, zero interest, and it has to be repaid back when the borrower pays off their first mortgage or sells the property. If they don't qualify for the partial claim, they go to a loan modification. It's a rate and term mod, which reduces rate or takes it to market rate and extends the term back out to 360 months. If that situation does not work for the borrower, and really all the borrower has to do is advise whether or not they can make that payment or not. But if they can't make the payment on the loan modification, then they go to the combination partial claim and loan modification, which allows for a combo to use a partial claim to cure the arrearage. It also allows for the rate and term modification to take the rate to market rate and extend the term back to 360. Could be some borrowers that have used previous partial claim allocation on previous delinquencies, so they may not have a full partial claim allocation of 30%. So in this situation, they would be able to use the remaining partial claim and do a loan modification to capitalize the remaining amount of arrearage to bring the loan current. If that situation does not work for the borrower, then they can go to the FHA HAMP combination loan mod and partial claim with reduced documentation. This allows for borrowers who may need payment reduction and try to hit a DTI or debt to income ratio of a 31%. Maybe that they're higher than that now. That allows for principal deferral with the partial claim. So again, the options in order would be, after coming off the forbearance, would be the partial claim, the owner-occupant loan mod, the combination partial claim and loan modification, and the FHA HAMP combination with the reduced documentation. For non-occupant borrowers who were less than 30 days past due as of March 1st, then we are offering now a loan modification, which is something new for us. In the past, a non-owner-occupant borrower, landlord, whatever you want to call them, were typically only able to get a repayment plan. So we did offer that rate and term modification, which takes the rate to market rate, and it extends the term to 360. So the standalone partial claim, it cannot exceed 30%, which is a statutory requirement, but can't exceed 30% of the unpaid principal balance. The borrower must indicate they have the ability to resume making on-time payments, and the borrower can advise either verbally or in writing, and no verification of income is required by the borrower to provide to the servicer. For the owner-occupant loan modification, let's say that a borrower decides that maybe they're kind of underemployed now. They are employed again, but they're underemployed, not making the salary that they were making. Then the loan modification would be the next step. If they can't resume making that the previous payment and use a partial claim for the arrearage, they would go to a loan modification. The loan modification simply, again, takes the rate to market rate. It extends the term out to 360, and it also allows the borrower to capitalize the arrearage into the loan balance. This may be a situation also for a borrower that has previously used the 30% maximum statutory value for a partial claim. Maybe a couple of years ago, they had a live situation that happened that they used all the partial claim, and so they don't have any left. So the loan modification would be the option available for them. So a combo of partial claim and loan modification. Eligible occupant borrowers would be reviewed for the third option, which would be this combination partial claim and loan mod. Basically what it is that, let's say that a borrower has used part of their partial claim previously, and they don't have enough partial claim to cure the arrearage. They would be able to use this along with a loan modification, or let's say that the partial claim they need principal deferral, then they would be able to use that to help bring the borrower's partial claim down to the affordable payment. And then the FHA HAMP loan modification would be for borrowers that, again, would need principal deferment, need a lower payment. It does require additional documentation. We do ask that the borrower, the lender, collects some basic information as far as income verification, things like that, because there is principal deferment allowed in this one. So again, we look for a DTI of about 31% on the waterfall. So they can only use the partial claim amount for deferment to get them down to the targeted payment amount of the 31% DTI. This one again involves a modification and a partial claim. Again, the partial claim uses a promissory note payable to the Secretary of HUD. That's 0% interest. And it also includes a subordinate mortgage payable to the Secretary of HUD for the partial claim amount. And then that becomes due and payable when the borrower no longer has an FHA insured loan, sells the property, or pays the first mortgage off. A non-owner occupied loan modification. So as I mentioned previously, for non-owner occupied borrowers, let's say that a borrower took out an FHA loan several years ago, starter house, then they moved on to another property, but they kept this property for rental. Previously, we did not offer anything except a repayment plan in our standard loss mitigation for borrowers who were non-owner occupants or landlords. But we did add a loan modification into this. So the borrower who is a non-occupant, that let's say they had a renter that's been unable to pay rent, the property's been vacant, they don't have any rental income, things like that, they would be able to go the route of a loan modification to bring the rate down to market rate and extend the term back to 360 months to try to reduce the payment. The property can be used as a rental property, secondary residence, or vacation property for the borrower. We asked for some basic information on that: a copy of the rental agreement, a written statement from the borrower, the landlord, that they or their renter has been impacted directly by COVID-19, is unable to make the rent payments, or has vacated the property. And again, the property can be used as a secondary residence or vacation home for the borrower that they may rent from time to time. Home disposition options. So let's say that a borrower has gone through all the retention options and determined that they just can't afford the property anymore. Maybe they haven't regained employment, their forbearance timeframe's up, and they're not going to be able to stay in the property. Then we do offer a short sale option or a pre-foreclosure sale and a deed in lieu of foreclosure. The pre-foreclosure sale allows the borrower to sell the property, avoid a foreclosure, and get a relocation assistance for participating in a pre-foreclosure sale option. Obviously, this is a better option if the borrower just can't afford to stay in the property. It's a better option for the borrower, and it's a better option for FHA also, as far as moving the property, getting it back into the neighborhood quickly, getting it back into the market, and getting a new owner into the property and taking care of the property. So if they try for a short sale and the short sale is unable to, they don't get a buyer on the property, then the next step that they would move to would be a deed in lieu of foreclosure. And the deed in lieu of foreclosure simply allows the borrower to deed the property back to FHA, avoid a foreclosure. It gets the FHA, then takes the property, puts it on their home.
That's the issue with technology. You know, sometimes it just doesn't go the way you planned. Go ahead.
That is true. All right. So again, we do have some limited. If the borrower doesn't qualify for anything on the COVID options, they can still go to our standard loss mitigation options, and requires a little bit more documentation, but they still have the ability to go through that process also, which effectively is the FHA hand. I do have some kind of online resources that are available. We do have a list of COVID FAQs, question and answers. We have HUD COVID resources and fact sheets. These are all on the HUD website. You could go to the Single Family Housing Handbook. We have supplemental documents in the handbook. We always have links to the HUD approved housing counseling agencies, FHA info announcements, and the single family default monitoring system, which the servicers are required to report to. So that's kind of it basically that for us. So again, I will mention again that the moratorium and eviction was extended to February 28th, and the extension for time to apply for a forbearance was extended to February 28th of 21. So we'll see if those get extended further as we have a new group that moves in, but that's kind of our update at this point.
What help is there for people who are in forbearance for a first home loan, but have a second loan or a HELOC?
Well, so we only insure, my group only insures the first mortgages. Mm-hmm. So I can't really speak to the home equity loans. I would suggest contacting their servicer, and they would be able to let them know what information is available for that home equity line of credit.
Okay, what options are available? Are balloon loans included in the modification forbearance program?
No, HUD does not have any, FHA does not have any balloon payments. Everything would be, the only thing that the partial claim is a subordinate note and mortgage that becomes due and payable after they pay off their FHA first lien. But anytime coming off forbearance, there's no balloon payment or lump sum payment required. Everything is resolved through a loan mod, FHA HAMP, partial claim combo, or something like that.
Okay. Are these options that you outlined listed in the order they need to be applied for the homeowner?
Yes, if you look at mortgagee letter, I think it's 2022, it lists those in the options. It goes with forbearance first, standalone partial claim, loan mod, partial claim and loan mod combo, and then the FHA HAMP with limited documentation.
Okay. Again, so you said you would share the presentations. Are there any outreach and or PSA materials for local agencies, municipalities use to help educate homeowners about the options, encourage them to reach out to their servicer, et cetera?
Yeah, if they look on FHA.gov, that website has a lot of information that, provides information for COVID, the COVID resources. I believe there's some fact sheets. There's some information for the borrower about who to contact, what to do, things like that.
Okay. I'm not sure if this is, okay. Okay, so I think that is it. I know, Ellie Pepper, if you have something additional, I can't really tell. I see you chat. I see a couple of things from you. Do you want to just ask Chloe? Can you unmute Ellie Pepper so she can ask what question she wants to ask? I see a few things from you, or has your question been answered?
Hi, Jerron. I did have my question answered. Can you hear me?
Yes.
I just wanted to comment about the outreach campaign. So there is an outreach campaign that is being put forward. And if anybody wants to reach out to me, I can provide the link. There's graphics available, there's text available, and it's co-branded with CFPB.
Okay. And there is a link to the CFPB website with the information you got on in preparation for this webinar. There's also a link to that website. And I think Ellie has put her email in the chat as well, in the Q&As. I think Ryan Maxwell, can you, Ryan, I don't know, he says if a tenant or a landlord, okay. Yeah, I think that's a question not for FHA. So I think we have reached the end of our questions for FHA. And there are several questions, but I don't think you can answer them, Matt. But we do thank you so much for providing this information. I've got several requests for your presentation. So if you can provide that, we will share that with the participants after the call. But thank you.
All right, thanks for having me.
Very, very helpful information. And you simply can't repeat this stuff enough.
All right, I appreciate it. Thanks for having me, and everybody stay safe.
Thank you. Thank you. So next on the line, we have several representatives from Fannie Mae and Freddie Mac, two companies that also back a lot of loans in the marketplace and are covered by the various forbearance and moratorium provisions. And they have some updates since our last call. And so I'm going to turn it over to Fannie and Freddie to introduce their speakers and share the information that they have.
Hey, Jerron, this is Teresa DeMay with Freddie Mac. I just wanted to flag quickly, we've got a great panel of speakers from both Fannie and Freddie today. It is 2:15, and I know that we have a hard stop at 2:30 for some of our senior folks, presenters on the line. So Jerron, if we don't get to questions today, we will definitely commit to, if you want to compile questions and we can work on following up on whatever we can't get to for the folks that have to jump right at 2:30, okay. We can do that.
Okay, thank you.
No problem. I'll go ahead and let, Fannie's going to go first. So Lauren, I'll let you jump in.
Yeah, hey, Lauren Shaloni here from Government Relations at Fannie Mae. We're going to kick it off with Cindy Danko, who's our VP for Single Family Credit Risk Policy, and then go ahead and turn it over to the folks at Freddie. Thanks.
Great. Hi, everyone. Can you hear me okay?
Yes, we can.
Awesome. Thank you. Really excited to be here again with you today. If you recall, my partner at Freddie Mac, Ben, and I, we're here with you guys back in May of 2020, which certainly seems like a lifetime ago. But, we're pleased to be asked to provide an update on things that we have been working on and providing to the market since that time. So just as a quick reminder, because I know we have just a short period of time, back in May, we talked a lot about forbearance and forbearance plans and what that meant for borrowers as it related to the CARES Act. Since then, we rolled out a workout option for borrowers who experienced a financial hardship and who are coming out of a forbearance. and that's called the COVID-19 payment deferral option. So as you all know, and as we have put out in our communications and on our websites, following a forbearance plan, a borrower is certainly not required to repay all of their missed payments at once, but they have the option through what we call a reinstatement, should they want to choose that option. If they don't choose or want to do a reinstatement, they can certainly put together a regular contractual payment or something that we call a repayment plan that allows them to catch up gradually. If neither of those options work for the borrower and they really just want to resume their current monthly mortgage payment, they can do that through our COVID-19 payment deferral that we worked on in partnership with Freddie Mac and, of course, FHFA. We announced that in our lender letters and bulletins and made it available to servicers to provide to borrowers in July of 2020. So really quickly, we're able to get that out to the market and again, help those borrowers who could ease out of forbearance right back into their monthly mortgage payment. In addition to rolling that out, both in our systems and through our communications, we also updated the Know Your Options website that Fannie Mae has, which is not just a Fannie Mae customer website for lenders and servicers, but also for homeowners and renters. And so we made the options available for borrowers in forbearance or coming out of forbearance available there in what we call Here to Help. That was all launched in May and of course kept updated throughout the summer and the fall months as we continue to work through solutions. And those websites, of course, have a whole bunch of different resources that homeowners and renters can use should they be considering their best path forward after forbearance. Let me pause there and turn it over to Ben from Freddie Mac and see, Ben, what else you want to add there.
Hey, thanks, Cindy. Thanks for having us, everybody. No, I don't have, I think you hit the nail on the head of a lot of stuff. We don't have too much to add here. Just reminding everyone, as Matt just did for FHA, we responded quickly. Cindy pointed out we actually had our policies out mimicking our disaster policies a week before the CARES Act came out. And it continuously updated to the point where I think both organizations set easy records for the amount of policy updates, whether lender letters or bulletins last year. We've transformed our loss mitigation options, as Cindy pointed out, continuing with the normal hierarchy, as somebody brought up earlier, in terms of options that are best for the borrower in terms of repayment and paying the least, and keeping that consistent. Also, we've, to the greatest extent possible, relieved servicers of a number of different functions that they wouldn't have to do in the middle of a health crisis like a pandemic, things like property inspections and different valuation things that, people want to socially distance and not have other people come in their homes. That makes complete and total sense. Additionally, I think we just hit on the foreclosure moratorium has been extended. You should have seen a press release earlier today from the FHFA that our foreclosure moratorium and REO eviction moratorium has been extended to through February 28th of 2020. And the one thing that I do want to highlight for everyone on the phone, people, I know we get this question a lot, especially with the fact that the CARES Act is so inconclusive in terms of a covered period, and the fact that other organizations have put things like end dates to a forbearance program. At the GSEs, Freddie Mac, Fannie Mae, we do not have an end date for the availability to get forbearance. Forbearance is in our blood. It is one of our existing loss mitigation tools that we have all the time for any borrower who has a hardship. There are some differences, obviously, borrowers impacted by COVID-19, notably that it expands the delinquency threshold, eliminating it in effect under the CARES Act, but forbearance is always available. So there is not going to be any type of expiration of forbearance. Borrowers, if they are just having a hardship now, are still eligible for forbearance outright. Additionally, just to bring up a couple of our website, our resources, since we did a lot of work since the start of this pandemic to ensure that not only have we updated all of our materials, all of our resources websites for the most relevant information, but did targeted campaigns as well in areas that had high concentrations of Freddie Mac loans, as well as high concentrations of the spread of COVID-19. And that is our My Home webpage on FreddieMac.com. As well as our #HelpStarsHere campaign. So with that, I think that's it for us at Single Family. And I believe I'm passing it over to Leanne Spees of Freddie Mac, our Senior Vice President of Multifamily, to talk about our multifamily efforts.
Sorry, just getting my camera set up. So thank you, Ben. And just to quickly, I know we are running short on time, so Leanne Spees, and thank you, Guran and NCRC, to have us here today, give us an opportunity to provide this update from a multifamily perspective. Very similar to the single family update. We were up there early and positive results that we've seen from the forbearances so far. Lauren Guerin represented Freddie Mac when we were back here in May, and Charles Ostroff is here on the phone today again from Fannie Mae, who will precede me in comments. As the nation's leading purchaser of multifamily mortgages, we were out there same time in March to get out our forbearance program when COVID-19 hit and was going to be as hard as we thought on the economy. At the outset, we created our nationwide forbearance program and have updated it with the CARES Act, and most recently, our FHFA, Fannie Mae, and ourselves offered additional forbearance through March, even though through the CARES Act, the forbearance program ended at the end of the year. In addition to that, in our updates since May, we have added additional tenant protections to our forbearance programs and continue to do that with our forbearance options throughout March. In addition, from a forbearance performance perspective, from a Freddie Mac perspective, we have about 1,200 loans in forbearance right now, just under 2.4% of our securitized unpaid balance. So very, very small numbers, but really there when we needed it. The bulk of those forbearances came in April and May, when really the market and our borrowers were unsure and unsettled of what was going to happen. We've seen a continued decline in the number of borrowers who need those forbearances, but are here and have them offered when they need it. In addition to that, it really is to the tenants of those borrowers who need the relief, and we've added different protections for them in our forbearance programs. Some of those examples are a 30-day notice of the evictions for anything that happens, that they cannot be evicted during the forbearance period. In addition to that, no fees charged to the tenants for non-payment, whether during the payment period, our forbearance period, or the repayment period. All of these protections continue as we offer the new forbearances through the end of March. Just a reminder though, Freddie Mac and Fannie Mae, we are a secondary market participant, and our relationship in that is with the lender and then indirectly to our borrowers. So our ability to aid renters directly is very limited, but we've had put tools in place in order to do so. In the beginning, we established a nationwide helpline with HUD, certified housing counselors, for free of charge to renters who need help. We've also created a lookup tool. This is the first time on the multifamily side that we've had a lookup tool, enabling renters or other industry participants to look for their mortgages and whether they are backed by Freddie Mac. And finally, we communicated the CARES Act requirements directly to our network participants and our lenders and those borrowers who we had contact with. So throughout this, good news is we've been in the mortgage multifamily industry and have able to support the borrowers and therefore their renters. We know there is much more to do, and we continue to work with FHFA and Congress and hopefully get the help out that is needed to the renters, and the current stimulus package is doing some of that. So with that, I'm going to hand it over to Charles to give any update from a Fannie Mae perspective. Charles?
Can you hear me?
We can.
Okay, good. I wasn't quite sure. But thank you, Leanne. Thank you, everybody. I'm going to echo a lot of what Leanne said as far as having forbearance and forbearance being a tool of the lender, and through that, indirectly helping or directly helping the tenants that are the properties through the moratoriums on eviction while the properties are in forbearance. From a portfolio perspective, I agree with the sentiments that Leanne talked about we really prepared for the worst and hope for the best. We have seen forbearances. They were up early. Definitely have seen them tail off. Currently, our portfolio through the third quarter of 2020, where we've reported, was 0.5% of our overall book, which is approximately $366 billion. The other resources that were available is the renter resource tool, where individuals can look up to see if they in fact live in a Fannie finance property and thereby are afforded those protections. Also, the Disaster Resource Network, which does provide financial counseling to individuals that call into it, and provides, if you want to say, links to help and assistance of renters that might need that. The other thing that I would like to point out is that under our loan documents, all of our borrowers are required to, abide by all laws and regulations. So thereby, any moratoriums that are set out legally, whether it's a local jurisdiction, whether it's a state, and whether it's the federal, then under our loan documents, it is a requirement of those borrowers to abide by those local laws. Again, we, just like Freddie, we were out early with our forbearance. When the CARES Act came out, had to make slight adjustments to it. The CARES Act did expire, as Leanne pointed out, the end of December. And like Freddie, our forbearance is extended until the end of March. And it's something that we will constantly be looking at what is going on within the market and potentially, where the market goes. So that's what I have, just to echo what Leanne says and just to point out where we are within forbearance.
All right, well, thank you. Is that the end of the presentation, or?
Yes, that's it.
All right, well, we do have questions here for Fannie and Freddie and whoever. Will you have any products to help people who have a first in forbearance but have a second or HELOC not protected like the first? They're asking this question because they're getting a lot of calls on this.
So, Dron, this is Ben from Freddie. I don't know if Cindy, I know a lot of people did have a hard stop at 2:30. Unfortunately, I think this one in particular, as it relates to single family, obviously, I think it's a single family question, is probably one more for the Fannie Mae side, as for Freddie Mac, we don't have any second liens in our portfolio. So, we obviously wouldn't have any solutions or any policy updates for mortgages that we don't own.
It's unfortunately Cindy had to jump off. She had a hard stop at 2:30, but we can follow up as needed.
Okay, we will, Francine, we will follow up and get an answer to that.
I'll connect with you, Jerome.
Okay, to that question. Ellie, okay, so Sandy Becker, are there any single family folks on the line from, okay. Can clients, I know that there is some lack of clarity about this, or you may not have a exact answer, and Ben, you said there is no end, but can clients with Fannie or Freddie loans still request a new forbearance?
Absolutely, they can. And this is in spite of anything else. At any time, mortgage forbearance is an option that is in our guide, specifically for Freddie Mac. It's in, I believe it's section 9203 of our guide. I should have that memorized, but I believe that's where it is. I know Fannie Mae has the equivalent. We are aligned in almost all, if not all, of our loss mitigation programs, policies, and techniques under the direction of FHFA. So forbearance will always still be available in some form. If, just as a quick brief, what is the difference between regular guide, if you will, forbearance versus the temporary policies in place for COVID-19? There are very few differences. The most notable is that under the CARES Act, it does not, limit any type of delinquency threshold. Normally, under a GSE loan, a borrower can get forbearance up to 12 months of delinquency, not necessarily 12 months, meaning that they make some payments. They can actually have forbearance longer than 12 months, but otherwise they can get up to 12 months of forbearance, 12 months of delinquency. We had to remove that threshold for people impacted by COVID-19. Additionally, under CARES, it required an attestation, not what we would call QRPC or quality right party contact. Very similar, but slightly different. So from a policy perspective, those are really the two main differences. The other one being that all property types are eligible for forbearance. Normally it would be owner-occupied properties only. But other than that, those are really the differences between forbearance for reasons of a COVID hardship versus forbearance for a reason of any other hardship. And borrowers, we know that some borrowers are just now having impacts from COVID-19, whether that be personal health or economic, and they absolutely can continue to apply for forbearance.
Okay. I think so. I think so just to clarify, in terms of, it's not just owner occupied. So there was a question on, is there any difference in the way? Well, let me not do that one. Let me do this one here. Will you be considering changes to your flex modification option? The option has limitations that may impede borrowers from using this option.
That's a great question. And the answer is, as of right now, that is not our focus. And it's because, a couple of reasons. One, we have made a number of updates. Again, we use what we call our disaster flexibilities under the flex modification. I know flex on flex. And that just opens up the program to more borrowers, including people who are originated within the last year, have failed the trial in the last year. Some of the normal exclusionary reasons that we would exclude somebody, the typical underwriting type of exclusions for a flex mod. So more or less every borrower in our portfolio is going to be eligible for a flex mod. The only times that they aren't going to be is if it's a government insured loan, like an FHA VA loan, in which case they'd follow the the government insurers' loss mitigation programs as opposed to ours. You heard Matt talk about FHA's programs earlier. Beyond that, we do have a program that targets a 20% payment reduction through a number of different pulleys, through potentially interest rate reduction, definitely term extension, principal forbearance, or deferral. All those things are part of the flex mod. And they generally work. People generally get payment reduction in excess of 20%. Our average payment reduction is well in excess of 20%. But there are some borrowers who are not able to generate any payment reduction. If we're able to generate any payment reduction, that borrower will be offered a flex modification. If we are not able to under the full waterfall, it doesn't mean the borrower can't be approved. It does mean that the request has to come into Freddie Mac's, at least for Freddie Mac, and for Fannie, it's Fannie Mae, our own operations department to review it on a case-by-case basis. Obviously, we don't want to really be putting people in mods that don't decrease their mortgage payments. So we want to work with the servicer to try to figure out ways outside of the specific delegated program to be able to help that borrower. But the reality is that, looking at our portfolio over the last number of months, Flex has been working as intended for COVID borrowers, and there have been a few borrowers who have not been able to qualify, at least from what we've seen. It's people that had just gotten their a new flex modification right before this pandemic. So we're working with servicers to submit those to us through what we call our non-delegated path for quick decisioning.
Okay. I'm not sure. I did ask about, just you did discuss what you've been seeing the last few months. Are there any general trends you can share with us? I think about what you're seeing in your book, and just general top lines of what you're seeing or trends.
It's a loaded question. There have been so many things going on recently, and I'm just speaking for single family, multifamily. Obviously, you heard Leanne and Charles earlier talking about a number of things as well, and I'll punt to one of them if they want to chime in there. But you know, in the single family space, there was so much confusion towards the end of the year about, does the CARES Act for single family forbearance expire again? We tried to put out as much information as we could that said no, for the GSE books it does not. We have an open-ended temporary set of guidelines that we announced a number of months ago. The forbearance again is in our blood. So that was kind of the thing we were dealing with. Obviously, the foreclosure moratorium has been extended now 2 separate months in a row. That's causing servicers a little bit of stress to try to figure out what's going on there. I think the biggest thing out in front of us today is this pandemic started, well, it started before, but it really hit home and became a national emergency in the middle of March. A lot of borrowers starting to miss their payments in early April and having to go on forbearance as quickly as that. And that year is almost up. And so many borrowers, and you can see this through our public information and eventually our 10Ks that come out. So many borrowers have been helped. So many borrowers have taken the payment deferral option, have gotten FlexMod, have been able to cure their missed payments through all the different ways that Cindy outlined earlier. It's been great, but there are borrowers. Number one, there are borrowers who have not been able to so far. They still have their hardship. Maybe they work in an industry that has not recovered. We know there are many. Additionally, there are a very small percentage of borrowers who have never taken forbearance, and we continue our outreach with those borrowers as well, including direct outreach to that population to try to get them to contact their mortgage servicers, remind them that there are options available, as we want to ultimately help them, whether it be through forbearance or something else, in resolving their missed mortgage payments. So that's been kind of our focus and our portfolio trends. I think you've seen through our public information. Delinquency rates continue to decline. Forbearance rates overall continue to decline. It doesn't mean our work is even remotely close to over, and we'll continue to figure out what's needed for those borrowers who still need long-term help.
All right. Well, thank you. Any more to add on the multi? You did say anything to add on the multifamily side? And I just want to remind people on the phone, we did send a series of links before this call, and some of those links were the mortgage loan lookup tool and the renter lookup tools provided by Fannie Mae and Freddie Mac. So you can link on to those and check whether your property is backed by Fannie or Freddie. But anything else that the multifamily folks want to add about things they're seeing generally in the market, and then we'll conclude.
So Jaron, our multifamily colleague Leanne had to leave. I don't know if Charles is on from Fannie. Otherwise,
I'm still here. I based upon what Leanne and I covered, I have nothing else to add.
Okay.
I think that we pretty much covered as it relates to forbearance, that it's still available. It had been extended even though the CARES Act has gone away. And, we're actively looking at the market and, as things progress.
All right. Well, I want to thank you all for joining us this afternoon. If anyone on the call feels as if their question wasn't answered or something like that, please feel free to email me at glevi, L-E-V as in Victor I, at ncrc.org. We'll look back through to see if there are things we missed. And I want to thank all of the representatives from Fannie Mae and Freddie Mac for getting on the call and providing some of the latest updates and information. Thank you very much. And thank you to all the participants. And we will be following up with the slide decks and other information that the presenters provide after the call. So thank you for spending some time this afternoon, and sorry we went over a little bit.
Thanks, John. Thanks for inviting us to participate.
And we'll keep you up to date.
Follow up.
Okay, thank you.